As a preamble, while we're waiting for others to join, over the past 20 years, I've worked in the energies and utilities industry. I've never seen a period of greater turmoil, which can only be described as market failure. The Australian energy market was not designed to accommodate the conditions that are currently present, particularly the rapid transitioning to renewable generation and the impact this has had on generator bidding behaviour, capital maintenance in the baseload generation sector, and the vertically integrated nature of the industry, or gen-tailers, that operate on both the buying and selling side of the wholesale market. The purpose of this presentation is to provide you with a description of current market conditions and our outlook on future conditions. I've aimed to do this in an objective and non-political way. At the outset, I'd like to declare that Energy Action is a strong advocate for renewables. We have advised renewables projects in terms of market feasibilities and actively support a number of corporates in the development and implementation of net zero and decarbonisation strategies. The reason I make this declaration is as we present our current market conditions, it requires a critique of the consequences of a rapid transition to renewables and the government's energy policy. The purpose of this presentation is to provide you with a description of those current conditions and the outlook of future conditions so that you can make an informed decision regarding your energy procurement activities. With this said, let's move to the presentation overview. Today, we'll be looking at the electricity market and describe the current market conditions and why prices are at record highs. We'll also look at energy markets outlook or future conditions and how market conditions impact future prices and what this means for your procurement activities. We'll take a look at energy market policy and why intervention is required, particularly in our market failure condition. We'll provide some recommendations for you in terms of electricity contracting, and that's summarised in 2 words, is to prepare now. We'll then take a look quickly at the gas market and outlook. Conditions there are improving, but are still not favourable in terms of prices. We'll then take a brief overview of environmental certificates and the costs and why a decarbonisation plan is becoming more critical. I'll then finish the presentation with a summary and in particular with reference to what customers should be doing next in terms of their procurement activities. So let's jump into it. It's a busy slide, but the key here is to look at the market curve, the market price curve, and in particular that of 2023. We can see that we are at record highs in terms of electricity and gas prices, and as most know, that has been fueled by global inflation, in particular the war in Ukraine and the impact on gas and similar energy prices. We're looking at a situation where there are regulated supply restrictions, again, particularly relating to gas, and energy market policy failure, where we can see that the current market conditions, and we'll describe how these curves reflect the market's response to energy policy. The central issue that has led to our current market conditions is the intermittent nature of renewables or intermittent generation, and the, I guess, failure of baseload generation availability, or the failure of corporate companies that own that baseload generation to provide the capital investment, the capital maintenance required to maintain plant availability and reliability. We'll look at how baseload has responded both to current policy settings and current market conditions, which we're seeing quite opportunistic bidding strategies in the wholesale market, which has forced prices, as you can see from these charts, to record highs. The ultimate position is that customers are in fact picking up the costs, both in terms of subsidising renewables and the energy policy issues that are driving prices to where we see them at the moment. Many customers have contracted for their 2023 procurement, but those that haven't are faced with 300 to 400% increases compared to their prior contracting periods. If your organisation hasn't or doesn't have the resources to actively monitor and manage your energy procurement, then really you need to appoint someone that can do that for you, because the consequence of getting it wrong is extremely costly in the current market environment. The costs of not planning procurement, we will see over time, impacting corporate viability, and particularly energy intensive industries such as manufacturing and mining. These charts just show the different state markets. So the first chart showing New South Wales and Queensland, these ones Victoria and South Australia, all demonstrate a very similar pattern at slightly different levels, but a very similar pattern where we saw a significant increase in the market. We've seen this drop off very recently and then a rebound. So all state markets experienced this approximate 30% decline, and that was in response to the threat of government intervention. So the ACCC produced a report a few weeks back encouraging the government to impose a gas reservation policy or trigger mechanism for East Coast gas. And that threat was sufficient for electricity and gas prices to drop. And so we saw this decline several weeks back, where there was approximately a 30% drop in prices across pretty much each of the state markets in response to that threat that a gas reservation policy and its impact on electricity is through the marginal cost of generation, that is gas-fired generation, which generally sets the price for electricity in the spot market. And so the threat of government intervention was significant enough to produce that drop in market prices. The market reacted to government intervening. Since that report was released, we've actually not seen the government act on that recommendation. And so the market no longer sees energy policy intervention as a threat. And so we've seen prices rebound from this chart, and they are trending back towards the previous high that we saw a few weeks back. This really isn't good news for corporates, particularly those exposed to 2023 contract prices, that is customers that haven't secured a contract, a fixed price contract for the calendar 2023 period. Unfortunately, with the rebound, that customers exposed to 2023 are running out of time, and really it's a situation where customers are just forced to enter into contracts at the prevailing market conditions. We'll move now to economic policy. As I just described, you can see how the threat of government intervention impacts the price for electricity. And this simple chart on the screen there just shows the balance between three key areas of energy market policy that equally impact. If you change one aspect of this pyramid, it impacts the other two. And they consist of sustainability objectives, which we are seeing a lot of announcements in the news and press regarding the government's commitments. We're seeing competitiveness, or really what's meant by that is cost competitiveness being impacted, or high pricing. And we're also very recently seeing the security of supply issues being affected. That is, we saw AEMO enter the market, suspend the wholesale market, and were forced to direct generators to dispatch generation to avoid what was effectively the threat of blackout or lack of supply. In terms of energy policy, it appears that we're overlooking the need to effectively plan for the transition to renewables. This significant move away from what was once a baseload designed market to a market that is having a higher proportion of renewables. And the government's recent announcement of a 43% reduction in carbon emissions by 2030 is in fact discouraging capital maintenance expenditure on baseload generation. And that is in fact having a significant impact on plant reliability. As we know, there have been significant outages from baseload plant, which has caused the extreme pricing that we're seeing in the market at the moment. And really, the only solution presented for the intermittency or firming of renewables that we've seen is more intermittent generation. And so we've described this as a train wreck in the making, that trying to address intermittency with more intermittency doesn't appear to be a logical response. Along with, as we mentioned, the government's failure to act on the ACCC's recommendations to implement domestic gas reservation policies, and beyond just the implementation of that policy, but the government's willingness to enter or intervene in the market. And so the market's responded to that situation. We've also seen state governments, particularly in New South Wales and Victoria, impose moratoriums, some very long-term, but imposing restrictions or in fact bans on new gas exploration. So it really shows an underlying ignoring the need for a transitional fuel as we transition from a baseload industry to a higher proportion of renewables industry. So the two key economic policy imperatives from our perspective are the gas reservation policy, or that trigger mechanism we just mentioned, and improving baseload plant availability, both effectively transitioning, providing a transitional fuel and an interim security of supply and cost competitiveness as we transition towards renewables. So really both of these two imperatives appear inconsistent with the current policy settings, and there's nothing in place in the short term to mitigate what we're seeing at the moment in the electricity market, which is extremely or record high energy prices. And similarly, as a side note, inflation. We're also seeing a significant energy cost inflation, obviously through the pricing impacts. Other aspects, removal or the reinstatement of the fuel excise duty, approximately 20 cents per litre, is also having an inflationary effect. And in our outlook, we're seeing a higher or greater influence on unions for wage growth. And so all these things are leading to inflationary pressures in the economy. And certainly as we see energy prices that are yet to, but are in the process of impacting on the calculation of CPI, that we expect that current inflation at 6.1% will grow to approximately 8%. And the point of mentioning this is that if you are currently contracted and it is linked to CPI escalation, then you would be budgeting for an approximate 8% increase in your year-on-year price increases. What are our recommendations? So moving to a response to what we've just described, you can limit the cost impact to your company. And one way to do that is taking advantage of market weakness, and that is being ready to act or respond quickly to what we're seeing these significant movements in price. So being in a position to be able to contract on price volatility or downtrends. And the importance there is that we can see this price movement has occurred reasonably quickly over the course of a few weeks, and that it's imperative that you're in a position to be able to take advantage of those price drops before they pass by, before we've moved to higher pricing levels, as can be seen from this chart. The consequence for uncontracted customers for the calendar 2023 period is really you need to procure your energy immediately. You really have no choice. It will be painful in terms of the year-on-year increases, but we recommend that you act immediately in terms of securing fixed price energy contracts for calendar year 2023. For the out years 24, 25 and 26, the recommendation is to start planning now for your procurement. Don't wait thinking prices will drop. What we've seen is a lack of willingness for government to intervene or to alter energy policy. And so what this means is that prices in the future are less likely to drop. We're more likely to see a bounce back in this curve back to previous highs. For 2024 electricity, our outlook, and it is quite dire, is that we're concerned that 2024 prices, which is represented by this green line on the chart, will start to look like 2023 prices over the course of the next roughly 12 months. And the reason for that is as you approach the consumption period, as we approach 2024, we'll start to see prices increase because the medium term turns into the short term. And what we're seeing in the short term is a lack of intervention, a lack of solutions to address what we're currently seeing. And by that logic, there's every reason to believe that 2024 will resemble what we're seeing in 2025. So the point here is to not defer 2024. We were looking, expecting government intervention to continue this price pattern downwards to a more stable and towards the long run cost of generation. That hasn't, so those conditions have changed. And so we're now recommending that you consider entering into 24, 25 and 26 contracts immediately. And one way to do that is to explore fixed price contracts or even structured products to manage price risk. And these products are designed to average costs over time or even outperform the market through an active hedging strategy. So without a change to the current market conditions, we're really seeing a potential train wreck coming for 2024 as we see that mid-term period turn into a short-term period as we get closer to 2024 or effectively partway through 23. Turning now to the gas market and looking at the dynamics there, we're seeing a similar situation for electricity, primarily impacted by global supply and demand, but retail competition within the domestic market remains very weak, with most retailers being fully sold and a large proportion of domestic supply being diverted to overseas markets or LNG exports. Retailers that do have gas are seeking prices, global prices, or looking to have prices on global parity, meaning that they're charging between $28 and $32 a gigajoule for 2023 supply agreements. And that's dropping slightly forward to $18 to $22 for the 2024 period. And that range just reflects, the individual customer's load profile. So how peaky your usage is or how varying your usage is over time creates that range. We're seeing some supply relief, and particularly that from Queensland, who doesn't have a moratorium in place, and a company called Cenex, operating out of the Surat Basin in Queensland, are proposing an additional 60 petajoules of supply during 2023, which we believe is sufficient. The ACCC report, which was released a few weeks ago, indicated that there would be supply shortfalls of roughly 54 petajoules of gas in 2023. And so we're seeing additional new supply come to market. Solutions such as LNG export controls, which we've discussed in this presentation, through application of the Australian Domestic Gas Security Mechanism, are now less likely to be imposed. Or we've referred to this as government intervention, and so we're seeing a reluctance on government's behalf to intervene in the market. The recommendation for gas is also to contract for your supply for 2023 particularly, and 2024 and beyond. Now, the outlook remains more favourable, but still unfavourable in terms of historic pricing. There is some relief in sight, so it's not a train wreck, but it is at this point in time extremely high priced, as you can see from those ranges provided above. We are seeing some downward pressure on gas hub pricing or spot prices that will eventually feed through to contract pricing, but because of the lack of supply, retail supply in the market, we're not seeing that occur in the short term. So timing remains uncertain as to when there will be longer term relief for gas pricing. Greater gas retail competition is likely to emerge from around September with a wholesale gas release. That is, it doesn't change the supply and demand conditions, but what it does is provide retailers with more guaranteed or wholesale contracted gas supply. And unfortunately, the details are limited around that September release, but we see that also as a potential for easing costs or putting downward pressure on gas prices. So our recommendation is to prepare now, certainly for 23, but in particular for 24 gas contracting, with a view to enter a fixed price agreement before calendar Q4 of this year. Turning now to the environmental certificate markets, and you can see from a fairly messy chart, but just focusing in on this teal or bluey green line here, where we can see the price for LGCs. That is the price for renewable energy, and that is effectively 1 megawatt hour of renewable energy represents one LGC certificate. And we can see from the chart below the price of those certificates for spot and calendar 2022 LGCs. We're seeing a price of around $55 per certificate, or $55 for every tonne of CO2 emitted, or the equivalent of 1 megawatt hour. So if you wanted to be 100% carbon neutral, you would purchase the equivalent number of certificates as your megawatt hour usage of electricity for scope 2 emissions. In terms of our outlook, so we're seeing a push towards greater regulation in carbon markets, and the ASIC recently warned that listing rules will include mandatory environmental reporting, and that is, whilst not in place at the moment, the ASIC are foreshadowing that coming. We're also seeing, as general observations, an increase in the requirements on corporates to have decarbonisation plans or net zero strategies in place. And some of the indicators there are bank borrowing conditions requiring organisations to have a decarbonisation strategy in place. And in particular from the insurance industry, we're seeing insurance companies requiring corporates to have decarbonisation plans in place if they want coverage, insurance coverage. And in particular in certain industries, that's becoming more prevalent than others. So our conclusion is to expect regulatory requirements for decarbonisation planning in place on all businesses in the near future. I'm just moving through quickly because I realise we're approaching time. The majority of the government's 43% target will be achieved through the corporate sector's voluntary activities, and that will most likely occur through a combination of both voluntary and RET imposed or renewable energy target compliance percentages, which we think will increase to the extent that corporate activities don't account for that 43% target over time. So we're seeing that corporate demand for LGCs will increase in order to both achieve what we see as increased compliance percentages or regulated purchases of renewable energy, as well as voluntary commitments or the unregulated or net zero strategies by corporates to achieve decarbonisation. So the demand for LGCs or renewable energy will increase. However, we also see that these targets will increase the supply of LGCs or increase the amount of renewable energy projects. The extent to which one outbalances the other will impact pricing, and our outlook is for supply to outstrip or exceed demand, with prices expected to decline from current levels by 2025. And we can see from the below chart here that 2025 prices are currently at $40, and the decline in this forward curve, so prices moving into the future decline, it's referred to as price backwardation, but these prices are decreasing over time. And the reason for that is the increase in supply or the move for additional projects to come online. Our conclusion, our recommendation for corporates is to commence the process of establishing high-level decarbonisation targets and to start costing those, with interim measures being put in place for 2025 and 2030 targets. And just as an aside, if you require assistance in developing a decarbonisation or net zero strategy, we do have a low-cost solution to assist you. So moving now to our final summary, really, what does this mean for you in terms of, we've touched on some of the actions that you can take, but really the key message for what to do next is to not put off gas and electricity procurement thinking things will improve. Unfortunately, the indicators and in particular energy policy settings are not supporting price pressure, lower price pressure. They're not supporting the market declining. And so our view is that by putting off or deferring your electricity procurement, thinking that prices will drop in the future, is likely to cost your organisation more than it is less. So don't avoid making a decision because costs are high. We know it's painful and the increases are hurting profitability in corporate Australia, but please don't avoid making a decision because of those reasons. And that if you don't have internal resources or the expertise to monitor the energy market, or you're not sure when or how long to contract for, please contact us. Let us advise you on those, because we do have expertise and are able to assist you in your procurement activities. Unfortunately, we can't promise to reduce your costs, but we can limit the increase by making good decisions around timing and our application, our understanding of energy markets. So for 2023 electricity and gas contracting, the simple response is to act now. The outlook is not favourable, particularly for electricity, but there are no mitigating circumstances at this point in time that would suggest that they are going to improve. For 24, calendar 25 and calendar 26 contracting, our recommendation to you is to prepare now. We're not expecting greater policy intervention. That hasn't materialised, and the signs are that there is a reluctance for the government to alter those policy settings. And so what was expected, relief for 24 and 25 pricing, and just jumping back very quickly to those charts where you can see that 24 and 25 pricing are significantly below current 2023 contract year pricing, that you can see there is some relief and the possibility to be able to blend or smooth costs if you are exposed to 2023 prices by averaging or smoothing your costs over time by taking a longer term or 3-year agreement. And similarly for 2024, electricity prices are more likely to look like 2023 prices. That is, that we believe that the forward curve for 2024 is more likely to resemble this curve as we move towards the end of 2023. Well, thank you everyone for joining us. That concludes the formal part of the presentation. I'm going to turn now to some questions, and we have one from Sebastian. Will there be grants available to move to electric appliances from gas to encourage the transfer? We know that there is quite a bit of talk and discussion, particularly in Victoria, as it happens, for a move away from gas to electricity. And we believe that the process of doing that will involve government assistance or grants to facilitate that move, because it's not something that will happen without an incentive to do so. Question from Sydney. What is the reason behind calendar 24 and 25 prices being so much lower? So what we're seeing is a transitional process driving 2023 prices higher. That is, that we're seeing a short-term impact, if you like, as we transition from baseload generation to a higher proportion of renewables. And so that is considered a short-term transition, and that there would be, over the longer run, the longer period, a lowering or de-risking in the market. And so 24 and 25 prices aren't being impacted by the current conditions in the market. So it really is a reflection that the issues that we're seeing, the crisis that we're in, is a shorter term or impacting 2023 more so than 2024 and 2025. However, as just described in the presentation, our view is that as we approach that short-term period, if there aren't solutions put in place, if they're, to address those two key imperatives that I mentioned, which is baseload generation, increasing the reliability of baseload generation, and addressing gas market reservation or the supply, satisfying the supply, satisfying the demand for gas in the domestic market before exporting gas. If those two factors aren't addressed, then what we will see is 2024 prices resembling 2023, because the medium term becomes the short term, if that makes sense. Moving to a question from Bryce. Do you expect the cost of green power to increase over the next 2 to 4 years? Yeah, great question. It does relate to the supply and demand conditions for those LGCs. So LGCs technically represent renewable energy, and that is in fact what green power is. It's just the CERs, the clean energy regulators, management of those certificates, if you like, to provide that green power. We are forecasting in terms of our outlook, as we discussed in terms of supply and demand, that being corporate demand for LGCs or renewable electricity, as opposed to the supply of those LGCs, the increase in renewable projects. And we believe that the outlook is for supply to outstrip demand. And a consequence of that, Bryce, would be that we would see the price of renewables or green power decline over time. And we can see that already in the backwardation of this, in terms of the prices dropping over this forward curve for those LGC or renewable electricity certificates. Okay, we have another question here. Are we seeing more investment in wind and solar at the moment? That's a question from Sebastian, and yes, we are. Yeah, we're seeing a significant increase in renewables. And just as a quick aside, you know, renewables, certainly grid scale renewables, I think you're referring to there, Sebastian, we're certainly seeing an increase in rooftop solar or the installation of what's referred to as behind the meter solar, and that is just exploding. In fact, to the point that corporate Australia is actually running out of space. We've actually filled our rooftops to the extent that we have installing solar. And just as an aside, I know I'll get to your specific question about the increase, but solar at this point in time is in fact a no-brainer. We're seeing very short payback periods, 18 months, and in some cases, depending on the circumstances, out to about 3 years. That means that with a short payback period and the benefit of offsetting network charges, which we know are growing at CPI, which is also significantly higher than it has been in the past, that by avoiding your network usage charges through rooftop solar, it is in fact highly feasible at this point in time. And really what we're telling customers is that if you're not installing solar, rooftop solar, you're subsidising someone that is. You're actually, you're subsidising, you're worse off, you're comparatively worse off than those organisations that are. And of course, as you produce solar, that can also feed into your decarbonisation plans. But we are, to directly respond, Sebastian, that we are seeing increased investment, both, of course, as just mentioned, in rooftop and also in grid scale solar. One of the consequences of grid scale renewables is because they are generally remote installations, that is, they are further away from load centres, just because of the nature of installing wind and solar projects and the land required to do that, they are further from load centres. And so what we're seeing at the moment is an increase in loss factors or marginal losses of generation being brought to the consumption point, the point of consumption. And undoubtedly, most customers will be familiar with a recent charge for unaccounted for electricity that is both a reflection of changing loss factors in the mix of energy, as well as some other factors that we're seeing, loss, theft, and the like. It's the difference between the way losses were accounted for in the past, which was traditionally the transmission and distribution factors, which are static and developed a year ahead of time, and the difference between losses from what is planned or expected and what the actual losses are turning out to be. And that's also a reflection of the costs associated with transmitting electricity over longer distances. Another question here, are corporates better off using LGCs or power purchasing agreements directly with generators? Great question, because a lot of corporates are asking the same question. How do I go about sourcing renewable energy? Do I do it through direct certificate management? Do I enter into a power purchase agreement? Do I install solar? And the answer is that for different organisations, that a different mix generally is reflective of that organisation's targets and goals, decarbonisation targets and goals. We recommend that, of course, that there are benefits and detriments to both situations of locking into a long-term power purchase agreement or having short-term flexibility. We are seeing corporates adjust their targets over time, and so flexibility allows you to do that. So by locking into a 7 to 10 year power purchase agreement, you're effectively locking in your procurement to your decarbonisation strategy. You have inflexibility. What we're recommending is you treat them independently. And in fact, Energy Action has developed a supply agreement called a RESA, or Renewable Backed Supply Agreement. It's an innovative product that overcomes the long-term detriments of a power purchase or direct offtake agreement. That RESA is typically a 1 to 3 year agreement, so it avoids that duration risk of entering into a long-term power purchase offtake agreement. And it also overcomes a lot of the transactional costs and the time involved in putting a bespoke power purchase agreement in place. So if you are considering sourcing renewable energy, we'd encourage you to look at our RESA, or Renewable Backed Supply Agreement. But for other organisations, the flexibility that comes from buying and selling LGCs will always outweigh locking into a procurement agreement. So it just comes down to the organisation's preference for flexibility around their decarbonisation. Well, we've just got a couple of minutes left. There is time for possibly one more question. That's not forthcoming. So look, thank you very much for joining the webinar. My hope is that it's been informative, that it's provided you with some insights around what's going on in the market, what the factors are that are impacting prices, and how you would respond in terms of your procurement. And really, as a summary, from what we're seeing, our outlook and the circumstances, the conditions that are in the market at the moment, that we're really encouraging corporates not to defer, not to think that prices are going to drop significantly in the near future, and to take advantage of current prices that we've seen for 24 and 25 that are significantly below 23, and to avoid deferring that in the risk that 2024 calendar prices start to look like what we're seeing for 2023. So thank you very much, everyone. And if you do have any further questions, please feel free to send them through. We can answer them offline after this presentation. Thanks very much, everyone. That concludes the presentation for today.